Hi, thanks for joining us today. Today we're going to talk about Payday Super. So from 1 July 26, Payday Super will change the way employers pay superannuation. Now, while that date might seem a way off, the changes involved are significant. I think they're the most significant changes for employers since the introduction of superannuation. Preparation will be the key, and in this session we're going to run through some practical steps and approaches to make sure that you're ready for Payday Super. These include cash flow impacts as well as reviewing systems and processes. We'll start with an acknowledgement of country, where we acknowledge the traditional custodians of the land which we are meeting today. We pay our respects to the elders, past, present and emerging, and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of Australia. My name's Matt Edmonds. I'm a partner at Cutcher & Neal, specialising in accounting and tax services. I love working with clients to help them achieve their business and personal goals. Since 1953, we've been helping clients build and preserve their business and personal wealth, and we provide comfort and clarity in our clients' financial future. We've got offices right across the Australian eastern seaboard, including Brisbane, Newcastle, Sydney and Melbourne. We have 22 partners across a broad range of disciplines and over 200 staff. We're a multi-award winning firm, including awards from Australian Business Awards as well as the Australian Accounting Awards. The award I'm most proud of is our Employer of Choice Award. So these are our core values. This is what we live and breathe every day. Being trusted advisors, always innovating, being true professionals, being stronger together, and thinking beyond culture. So we're making a positive impact and serving the community. So when we're talking to clients, we always refer back to our 7 pillars of success, not just looking at one facet of their financial picture, looking at a broad range of issues to make sure that we're helping them achieve their wealth creation goals. And as I said, we're a multifaceted financial services firm, and we offer services across a broad range, including accounting and tax, business services, systems, cloud accounting, finance, investments, and so forth. So what are we going to cover today? Firstly, we'll look at what's changing under the Payday Super rules. Then we'll look at how contributions are allocated to the employee's super accounts. Next, we'll look at what happens if you pay super late. So what are the penalties for employers? Then we're going to look at onboarding of new staff, which is a really critical step. There are some other important changes that are coming in for Super on 1 July, so we'll run through those as well. And lastly, we'll look at some cash flow impact and practical systems reviews. Finally, we'll finish up with some frequently asked questions. So what's changing? Under Payday Super, superannuation payment terms are changing from 28 days from the end of each quarter to the same day as wages are being paid. So if you look at my example there, we've got an employee that's paid on the 1st of January 26. At the moment, their contributions are due to be paid by the 28th of April 26. So it's going from a maximum of 118 days all the way to the same day as paying employees. So under Payday Super, from 1 July, Super Guarantee is calculated as 12% of qualified earnings. So qualifying earnings is a new term and includes ordinary times earnings, which is the current definition, as well as some additional items. Now, under Payday Super, Super is required to be paid to the employee's superannuation fund within 7 business days of paying employees. Now, there are some limited exclusions that apply here, and we'll run through those shortly. The key point to here is it's not just the day that it leaves the employer's bank account. The 7 days also has to cover the amount of time it takes for the clearinghouse to pay the super fund, so we can allocate the amount to the members' super account. So employers really need to talk to their super clearinghouse to confirm how long their processing time is as well. Now, if we look at the way the contributions are allocated, my example here, we've got an employee that's paid on the 1st of July $1,000 in qualifying earnings. That means the superannuation payable is $120, and 7 days from the 1st of July, after you take into account weekends, means that the super is due to be allocated to the employee's account by the 10th of July. Now, if we keep on paying this employee through the month of July, we've got each of those SG due dates. And my example here, we're going to look at where an employer has missed a payment. So They've made the first payment, they've missed the second payment, and then they've made each subsequent payment. Now, the contribution ordering rules apply each payment to the earliest outstanding amount. So you can see in my example here, we've got the payment due on the 17th was missed, and then the employer continued to make those payments. However, each of those payments are now considered late because it missed the payment on the 17th, which caused this domino effect of late payments. And that means that each of those amounts would be subject to superannuation guarantee charge. So this is a key point to make sure that employers are really across what their payment terms are and when they're making their payments. Now let's think about the June 2026 quarter superannuation. So this superannuation amounts are subject to the current super guarantee rules, which means the due date for payment is the 28th of July. Now, employers should consider paying this amount prior to making their first super payday payment. Otherwise, those payments will be allocated to the June quarter superannuation. So I suggest you talk to your advisor on how you're going to make your June quarter superannuation payment, just to make sure that this doesn't result in any unforeseen late super payments. Now, what happens if the amount is paid late? Amounts are paid late are subject to a superannuation guarantee charge, and there's a new voluntary disclosure form. If you don't voluntarily disclose, then the ATO will actually do data matching themselves and raise the liability. Now, there's 5 components to the superannuation guarantee charge, and the first 3 components are now deductible for income tax purposes. So that's a win for employers. Previously, these amounts wouldn't have been deductible for income tax purposes. The first component is the shortfall superannuation, and that's based on qualified earnings. So that's the super that hasn't been paid. Now, previously, late paid super would also bring into account overtime, and that doesn't under the new rules, which is a win for employers as well. The next component is notional earnings. So this amount is calculated based on daily interest charge, and that interest rate is currently calculated at 10.96%. And this goes to the employee to compensate them for the late payment of the superannuation. Now, the biggest change here is this administrative uplift, and this is imposed at the ATO's discretion and can be up to 60% of the shortfall super. Previously, this was only $20 per super guarantee charge, so that's a big change. The next components are if the amount continues to be outstanding after the assessment of the superannuation guarantee charge, there's an additional general interest charge and additional penalties of up to 50% of the outstanding amount. Now, these 2 last amounts are not tax deductible. Now, let's look at a quick example. Got an example of an amount of $1,200, which is paid 20 days late. Under the current rules, the biggest difference there is the administrative charge. So it was only $20 under the current rules, resulting in a total amount payable of $1,226.58. Under the new rules, the admin charge is up to $720, which results in a total amount outstanding of $927.02. The thing to note about that as well is the administrative charge is payable to the ATO, not to the employee. So the employee doesn't even get any compensation for that. Now let's look at onboarding of new staff. This is a really critical step to make sure that you meet your super payday obligations, and it's often the cause of late or delayed super payments. Now, the good news for employers is the due date for payment is extended to 20 business days after the first qualifying earnings day. So that's after the first time you pay that employee. There's no changes to the super choice rules, so employers are still required to provide employees with the choice of where they would like their super contributions. And I'd also note there that employers must have a default super fund. So if an employee doesn't have a stapled fund or they have decided not to choose their fund, employers must offer a default superannuation fund. Many payroll systems such as Xero and Employment Hero are updating their systems to electronically onboard staff to help streamline this process. Just looking at stapled funds, so if an employee has a stapled fund, the employer must provide the super contributions to their stapled fund. Employers can request details of an employee staple fund via online ATO online services. And yeah, the ATO will provide that information so you can make that contribution to the employee. Now, how does the ATO determine what their stapled fund is? There's basically a bunch of tiebreaker rules and where the last contribution received and what the member's account balance is. If an employee makes a contribution to a fund that if the employer makes a contribution to a fund the employee didn't choose, i.e. their default fund, and the employee already has a stapled fund, then the ATO will impose some super choice penalties. So it's important for employers to check with the ATO to see if an employee has a stapled super fund. So what other things are changing in terms of superannuation? One thing that's changing on 1 July is the maximum contributions base. So the maximum contribution base is in relation to the maximum superannuation payable for an employee under super guarantee. Currently, that's based on an amount of $62,500 per quarter, and these amounts reset each quarter. Going forward, these amounts will change to an annual threshold, which is capped based on the concessional contribution cap. At the moment, the concessional contribution cap is $30,000. So once the employee reaches the total amount of super paid for the year of up to $30,000, the employer is not required to pay any more superannuation. So you need to check your employment contract to determine the basis for paying super. That's a really important step. The other thing to note there is high income earners with multiple employers may opt out of having super guarantee applied to their wages based on a shortfall exemption certificate. So that can be lodged with the ATO. Now let's look at an example. We've got an employee that's paid $400,000 gross wages. Under the current rules, you'll see there that he will max out the super contributions each at the end of each quarter, so they don't need to pay super in the September, December, March and June months. Under the new rules, the superannuation will continue to be payable up until February. It's really important that employers update their systems and make sure that they're configured correctly. Otherwise, they may result in shortfalls of super being paid if they're still being applied in the current rules. This is really important for high income earners who change jobs during the year, or income earners who have multiple jobs, or employees with variable remuneration, such as commissions paid and bonuses. Another important change that's coming through at 1 July 26 is the superannuation small business clearinghouse is going to be closed. So employers should be transitioning away from this clearinghouse now. June 2026 contributions made before 30 June 26 will be processed, but further there'll be no more contributions being able to be processed via the clearinghouse. And it's also recommended to extract any historical data before 1 July as the clearinghouse will be completely closed. Now, the ATO have issued what they call a practical compliance guide, and this is advising taxpayers and advisors around what they're going to do in terms of their compliance approach for the first year of Payday Super. And they've adopted a traffic light system, which is their way of approaching these sorts of things at the moment. Really, what they're saying here is they're going to show how they're going to prioritise their resources in terms of looking at reviewing and applying penalties for employers. So under this system, they're saying if there's a low amount of resources being allocated to errors that are being resolved quickly, if they're seeing employers that are paying amounts but not resolving those amounts before 28 days at the end of the quarter, then they're going to allocate a medium amount of resources and then a high amount of resources. So they're really going to target those employers that aren't making sure their superannuation payments are made 28 days after the end of each quarter. Now let's look at some practical applications. Got an example here of what the difference between the cash flow impact of superannuation under Payday Super compared to the current rules. So the current rules is the blue line there showing an amount payable on a quarterly basis. And now we've got $100,000 of wages payable per month. which really results in a cash flow impact of 36,000. So under Payday Super, 12,000 will be payable each time there's a super payment due. And under the previous rules, this 36,000 wasn't actually due. So let's look at a practical application. I've got an example here. We've got $100,000 in gross wages paid per month. Currently, the employer is paying that superannuation quarterly by the 28th of each, at the end of each quarter. Going forward, this will result in $12,000 of super payable per month compared to $36,000 payable at the end of each quarter. So that results in a real cash flow impact, taking that amount out of the working capital of the employer of $36,000. Now, what should employers do? Let's look at some other cash flow tips. So to help improve their cash flow, employers could do things like review their customer payment terms and tighten those up, consider retainer arrangements where customers pay on a retainer, increase invoice frequency, so making sure you're issuing invoices to your clients on a timely basis or more repetitively, improve your collection process, so review your debtors collectors process, make sure you're tightening up your debtors terms. The other side, you could look at extending your supplier payment terms, so negotiate some extended terms with your suppliers. Prepare a cash flow forecast, so make sure you factor in Payday Super into your cash flow forecasts and a regular review. And then consider payment methods such as upfront payments, EFTs, direct debits, things like that. Now, systems reviews, so it's important that systems are reviewed and updated to make sure that they're equipped for Payday Super. So as part of that, you should ask yourself the following questions. Does your current payroll system meet the requirements of Payday Super? What is your employee onboarding process? Is this streamlined? Is this electronic? Can you improve this process? How long does it take for your clearinghouse to process payments? This is a really important part because it's out of your control as an employer, so you need to make sure that you're using the clearinghouse that's able to process payments as quickly as possible. Common clearinghouses like the clearinghouse that Xero use are also updating their systems and scrambling to get things ready before 1 July. So you should be talking to your clearinghouse and getting some information on that as soon as you can. Then ask yourself, what changes to be made prior to 1 July? What do we need to implement? And what can I do now to be ready? So there's nothing stopping employers from actually implementing Payday Super early, just to make sure that they're across what they need to do so they don't get caught out in terms of once it kicks in. Now let's look at some frequently asked questions. So commonly asked questions include things like, are there any exempt employers? And the answer to that is there's no. So there's no de minimis rule, there's no related party employer rule. All employers are subject to Payday Super. Another question that's commonly being asked is, can employers change their payment frequency and or timing? So frequency, what they're talking about there is changing from, say, weekly up to fortnightly, which means that there's less super payments being required to be made. Timing would be something like people are talking about changing their payday from, say, a Wednesday to a Friday, which means that you get 2 weekends in the 7 business day period, allowing some more time to get that payment to the employee's account. So yes, it is possible to make these changes. However, it's very important that you review awards, employment agreements, and any enterprise bargaining agreements to make sure that any changes are in accordance with those. So we'd recommend making sure that any of those things are covered off before you make any changes to your payment frequency and or timing. Another question that's come up is what is the due date for non-employees that are subject to superannuation, such as contractors? So the due date for these payments for superannuation is 7 days from the payment date made to the contractor, not the invoice due date. So if an amount is due and paid on a different date, the super contribution is due 7 days from that payment made to the contractor. And can employers start paying super on payday now? The answer to that is yes, they can start paying super on payday to get their systems, and we'd recommend that employers actually start to implement these changes as soon as they can. So where to from here? Really, I guess the key message is act now. Think about what the changes will mean for your systems and processes. Think about what you need to do to actually be up and ready, because as soon as these rules come in, the ATO will be watching to make sure that employers are complying to the new Payday Super legislation. The other thing you should be doing now is preparing for the cash flow impact. So this is a significant impact. As I've talked about earlier, it's going from 118 days payment terms to the same day. So employers should be factoring in that cash flow impact now and making plans for that, and looking at those tips that we did earlier around what they can do to improve their cash flow in other areas. Employers should also be reviewing their systems and processes. So talking to your clearinghouse, reviewing your payroll systems and making sure that it's up to date, ready to go for Payday Super. So where to from here? My biggest takeaway would be for employers to act now. Payday Super rules are coming on 1 July 26, and you need to be prepared. There's a lot more superannuation payments due for employees, and if your systems and processes aren't up to date, then those penalties will reel and they'll stack up very quickly. Prepare for your cash flow impacts. So factor in superannuation payments into your cash flow forecasts and look at that impact now. Also look at the other tips and things you could do to improve your cash flow to make sure that your working capital is topped back up with the tint that it's going to take from the Payday Super payments. Review your systems and processes, so make sure your payroll system is equipped and ready to go for Payday Super on the 1st of July. And also do things like talk to your super clearinghouse and make sure your default fund and all those sorts of things are up to date and ready to go. Now, communicate with your team and training. That's really important as well. Make sure your payroll processing team are across what super payday rules are and what it means for them, so they're equipped and ready to go as well. And lastly, look out for our checklist. We're going to send you a checklist with some useful information, tips and things to make sure you're equipped and ready to go. So thanks for joining me today. I hope the session was informative and you'll be ready to go in terms of your Payday Super rules. We'd love to hear your feedback as always, so please scan the QR code and complete a short form. Thanks very much for joining me. Have a great day.